The Nasdaq has sold off for a fifth straight week. By Friday's close, the index dropped another 149 points, ending the session 2,800 points below the high set in February. The selling is broad and synchronized. The Dow has officially entered correction territory, while the S&P 500 is currently weathering its longest weekly losing streak in nearly 4 years. In retail circles, this simultaneous breakdown across every major index is being treated as a chaotic reaction to the latest headlines. This lack of rotation, where money leaves every sector at once, suggests a broad exit from risk assets rather than a temporary shift in investor sentiment. Geopolitical tension is the primary macro driver. President Trump extended the deadline for strikes on Iranian energy infrastructure to April 6th, and Brent crude responded by climbing above $110 per barrel. At the same time, the 10-year Treasury yield rose to 4.47%, its highest close of the month. We are seeing a risk-off environment where both stocks and bonds are being sold simultaneously. This is a departure from a standard market pullback. This process is known as institutional distribution. Large players begin offloading inventory in a structured manner, liquidating positions across the board while managing the impact on price. While headlines fuel the retail narrative of fear, this distribution process leaves specific, high-volume data points on the chart that we can use to track the flow of capital. Thursday's session was a displacement event. Large participants moved price aggressively on high volume, which resulted in a massive 610-point intraday range. At the open, the index pushed up to 24,421 to sweep retail buy stops. Once that liquidity was captured, the market instantly reversed. Following that reversal, aggressive selling took over, pushing the Nasdaq down 658 points into the closing bell. This level of volume and speed shows large players actively driving price lower to find the liquidity required to offload their inventory. Friday shifted into a mitigation phase. Price retraced into a fair value gap, an area of structural imbalance between 23,900 and 23,950, and then sharply rejected the zone. Large players often use these brief retracements to add to short positions or finish selling remaining inventory during periods of lower volatility. Friday's magnet, or fair value, was 23,800. The market opened above this level but spent the day drifting below it, which established a bearish bias early in the session. Sellers established the ceiling at 23,974. They defended this level with precision, turning a previous floor into a ceiling to maintain the downward pressure. The floor held at 23,614, but the sell-side volume was double that of the buyers. This suggests that the current support level is under extreme stress. When the ceiling is successfully defended while the floor weakens under high volume, it indicates that the internal structure of the market has broken. The macro outlook is worsening. The VIX is approaching 30. Consumer sentiment is at wartime lows, and the geopolitical deadline remains a major uncertainty. If the current floor breaks, price will move toward the institutional order block between 23,400 and 23,500. Just beneath that zone lies a liquidity pool filled with retail stop-loss orders from traders who bought the dip. Trading through that level would trigger a cascade of those stops, potentially accelerating a move toward the March 10th low of 23,100. Until the market structure shifts, the concentration of retail stops remains a target for the algorithms of large participants, keeping the path of least resistance lower. For the bias to turn bullish, the Nasdaq must reclaim the 23,800 magnet and hold that level on a closing basis. Until we see that structural change, bounces back toward the ceiling should be viewed as opportunities for the market to continue its distribution. Identifying these institutional levels allows a trader to rely on a repeatable process, rather than attempting to guess the next move based on emotion. To learn how to build your skills session by session, subscribe to the CIY Capital YouTube channel for our daily trading and training videos. Follow Ron Rose Trading on Instagram for daily pre-market recaps, or visit CIYcapital.com to book a live session or one-on-one coaching. Applying a structured framework to the charts is the first step toward finding consistency in your trading. See you Monday.